When it comes to business valuation, very simply it comes to your mind, okay, we are going to give a value to a business. We are going to give a value to a business. So then when it comes to giving a value to a business, sometimes you may think it's not that difficult, but giving a value to a business is it's not easy as you think, because it has so many things to be considered, and it's a very subjective value. If it is a straightforward value through a particular formula, we can arrive and say, okay, this is the value of the business. But in the real world, valuing a business is a highly subjective nature. When you say subjective, it will differ from person to person. The way I value the business is maybe different to the way you value the business. So therefore, it's the subjectivity is involved. So therefore, we need to get an idea how we are going to value a business. So therefore, there are so many methodologies available in this process, and so many models are available. So we need to get an idea about the prevailing models and try to understand how a business value can be arrived. So therefore, is business valuation. And then I will be discussing why we need business valuation. Why we need business valuation. And finally, we'll be discussing about how we do a business valuation. So these are the three key things that I will be addressing in throughout this presentation. What is business valuation really means, why we need to do a business valuation, and how we are going to do a business valuation. Fine. So let me start with the first one. What is business valuation means? Now there are so many definitions about it, but let me start with a very simple one. Business valuation determines to give an intrinsic value to a business. It is said that the business valuation determines to give an intrinsic value to a business. So what do you mean by intrinsic value? So if you get the basic idea, intrinsic value can be the core value of the business, or the basic value of the business, or it can be the fundamental value of the business. Right? So very simply, we are going to say, okay, this is the value of the business. So if we are going to say, okay, this is the value of the business, as I told you, it's not that straightforward. So this also can be defined in many ways. If I just explain the next slide, it also says business valuation as an act or process of determining the value of a business ownership interest, security, or intangible asset. So in very simply, if I highlight the key areas of that, it is an act or process of determining the value of a business, or it can be a business ownership interest, or even a security or an intangible asset. Okay, so it's a process of determining the value. Another alternative definition, to be more clear on it, there are hundreds of definitions on this area. Another alternative one, business valuation is a logical, defendable process of arriving at the opinion as to the worth of a business given the information available, assumption, and limiting conditions as on the valuation date. So basically, we are giving a logical justification. This is the value of the business based on the prevailing information. So very simply, another way of expressing what is this business valuation means. Fine. Now let's move on. There are so many thoughts on valuation. There are so many thoughts on valuation. Some people say valuation is an art more than a science. As I told you, it's the subjectivities involved. So if it is subjectivities involved, they say business valuation is kind of an art. If you look at so many uh, videos and discussion and research papers on this area, they emphasize that it is highly subject and it's differ from person to person. So that's why they say it is kind of an art, not as a science. And also they say valuation is more of subjective nature than objective. As I explain again, it's subjective nature than objective. Okay, so valuation depends upon perception and skills of the valuer. It's about a perception. So if you take an example, we look at a particular painting and try to give a value. So I have a different view of it and I'll give a value. It will be totally different to your value. So it's very similar like that. So what they're saying is, by like giving a value for a painting, we are going to give a value to a business. And it also says that valuation has a reference to time. Even a single person can have different values at different times. So not only from person to person, even the same person, the value that I'm giving on the business today is totally different, probably another 1 month's time. Because of the variables and my perception, I may give a different value over time. Also, price is paid for the deal, value is in the eyes of the payer. Again, they call it's the eyes of the payer. Now, sometimes if you take a product, there's something called a product value, and plus there's a value where the customer is giving. Sometimes if you take a service or a product, you are so happy because you say it's a value for money, because you have a more perceived value. You are even willing to pay more than what actually the price is, because you have a better perception on that. Sometimes some people may not happy to pay that price because they say it's not giving the right value for you. So therefore it's a perception. So it's kind of an eye, how you see from a payer's point of view. And also they call valuation is a critical tool for strategic business making. I'll be discussing further on this point, because based on the value, some organization can collapse, some organizations can be totally lose their market share. So therefore valuation is a very crucial point for a business. And also valuation is an application of theory and practice. Right, so these are some of the thoughts of valuation. Right, now let's move on. Now this is a picture that you may see, a big building, and I have just come up with a figure. Value of this firm is $800 million. Now, when I come up with $800 million, you may have a question, what is the rationale behind it? So as I told you, it is a process of justification. I am saying, okay, this is 800 million based on these reasons. But another person may say that may be 700 million. But he or she has his own justification of that 700 million. For another person, it can be over a $1 billion. Okay, so therefore, as I told you, it's highly subjective. Therefore, it's an art. So we are going to learn how can we give a value to a firm. And also, before continuing, I just want to emphasize another point. When it comes to valuing a business, you need to keep in mind there's another weakness of this valuation as well. The main weakness is, it is very similar to accounting as well. There are certain things we can't give a financial value. If you take about, before talking about a business value, think about a value of a person. Okay, now you would have heard there's an index called Billionaires Index. There's an index called Billionaires Index. Now this index is produced on yearly basis, and recently, as per the latest surveys, that about more than 6,600 billionaires in dollar terms in the world, and this is keep on adding every year. So billionaires in terms of dollars. So the top person for so many years was Mr. Bill Gates. Probably would have heard, definitely would have heard this person. He is the chairman of Microsoft. Okay, so he has been for so many years, and for a few years he was not in top, but again last year he's moved back to ranking number 1 as the world's richest person. And he claims his value as a person is $81.2 billion. Now, here he's trying to come up with a value as a person. Okay, wealth or value of myself is $81.2 billion. Now, how come he says that this is my value? Definitely, he may have a certain way of calculating his wealth. Okay, so we are going to discuss further, but we need to remember there are certain values that we won't be able to see by that 81.2 billion. Now, if you take an example, think about the kindness, the honesty, or the method. Some people are very methodical. Now, none of these things will not be captured from that value, but those are also value. We call values, people values, but none of these things will be captured from this financial value. Why? You can't give a financial value for these particular values like kindness, the cariness, the honesty, the integrity, the ethicalness. We can't say, okay, this person is 1 million ethical and 3 million honest. So therefore, this is one of the main weaknesses. We need to know that before coming up with a value. We can't identify certain values because we can't give a financial value to these particular things. If you put the same thing to a business point of view, there are things which you cannot give a value even from a business point of view. If you take an example, the image of the business and the certain values that they have been maintaining from the inception by the co-founders. I'll give you with an example. Now, I'm sure you have heard the company called McDonald's. One of their core values, things that they are going to continue from the inception, is the cleanliness. Now, if you would have gone to a McDonald's restaurant, sometimes you would have seen there are a lot of waiters. Every time they used to come and clean the place. So that's one of their values that they have created from the inception. But we can't give a value in terms of financially. This is the value of that particular that quality. So therefore, like that, the image of the business. Some organizations, they are driving certain values. If you take an example, Volvo, they always drive the safety for their product as a value. If you take an example of Apollo Hospitals, it's a international chain. They always follow the value of social care, the well-being of their society, and these things will not captured from his financial value. So you need to know, okay, we are trying to give a value, but then again, certain things cannot be captured from this method as well. So that's one of the key weakness of this most of the models that we are using, because it does not give a financial value for some of the qualities of that business. Okay, so therefore, now we have come up, okay, the value of this business is $800 million. Okay, so to arrive this, I have to concern about so many factors. So these factors may decide this value, and I will just list down some of the things. Now the first point, the nature of the business and the history of the enterprise from its inception. Okay, so you know some organizations are more than 100 years old, 200 years old. So they have come up with, they maintain a prestigeness with their organization. So the nature also matters a lot. Some organizations, the nature will decide the value of the business, and economic outlook in general, and the condition outlook of specific industry in particular. What do you think about it? So when in certain industries, they are the nature of such industry, they are high capital intensive. If you take an example of manufacturing organization, a lot of automated industries, you see a lot of high intensive organization. So that particular industry, you can see the value is different to a software company. Okay, the way you give a value for a software company. Now, if you take an example, now there are so many software companies in Sri Lanka. Any software companies you have heard of? Virtusa, and there are so many organizations like Virtusa, one of the very the key organizations, Virtusa, and Millennium IT, IFS, and so on. There are so many IT firms. What is the nature of such firm? Do you see lot of machinery, lot of manufacturing plants in such organizations? No. So such organizations, what is their main asset that you think? The main asset of software companies, yeah? The employees, or we call the developers or the programmers, or basically the staff, that has a huge value. But then again, you can't easily tell a value also for a person. Okay, this person worth 2 million for the business. So there's an issue. But we know they are the key value drivers to the firm. So probably if they leave the organization and join a competitor, they may lose the business also. So you know that there's a huge impact to the business, but can't give a value also. So these are the things that you need to concern before going through this all these calculations. Also, if you take an example of a high intensive organization like if you take a cement manufacturing organization or a tea factory, you see so many machinery, lot of capital infrastructure is there. So in such organizations, the value will be mainly represented by the machinery and equipment. If you take an example of a supermarket, okay, the largest, the retail chain in the world, the Walmart, which is called the largest, even the turnover of the as an organization, the largest turnover as an organization. Even in Sri Lankan context, we have so many retail shops, main companies. What are the chains? We have Cargill's, Ceylon, and then we have Keel Super, and we have Arpico. So these are one of the main retail chains. What is their core assets, if in your opinion, in these type of organizations? Their core asset, the stocks. Yeah, the stocks they have. You see, probably half of their wealth is the stocks they have, because there's huge amount of stocks, because that is their main business. So such organizations, for retailers, they have stocks as their main asset. Now you can see from organization to organization, the industry to industry, the nature of these assets also change. So therefore the value of the business also change with the change on this nature. So we go to the next one, book value of stocks and the financial conditions of the business. Now you know that some organizations are always blessed from the government backup. So when such government backup is there, they will get a lot of projects. So they have more projects and more prosperous future than the rest of the players in that industry. Okay, so if you take an example, in the past we saw access engineering. They used to get so many projects from the government. As a result, they used to get a lot of financial good performances over the years through that government backup. So it has more favoration. So when you have the government backup or government subsidies, such organizations have more prosperous future than the rest of the players in the industry. And also the earning capacity of the firm. Some organizations has huge earning capacity and dividend paying capacity, which we'll be discussing further in the future. The dividend capacity, the ability to pay more dividends, If you take an example of all the multinationals in Sri Lanka, they used to pay very high dividends. What are the main multinationals that you know in the Colombo Stock Exchange? Some of the main multinationals. You have Ceylon, Unilever Ceylon, and you have Ceylon Tobacco and Nestle, and we have Aviva now, it's AIA, Chevron, Lanka. So there are so many multinationals also in Sri Lanka, and those organizations tend to pay a very high dividend compared to the local groups like Haley's, Hemas, Aiken Spence, John Keel's, Laugh Group. Now, those are all local based firms. So you can see their dividend payment patterns are also different from local to foreign organizations. So when the dividend patterns are changing, it has a reflecting the value of the business as well. So we will learn those things when you are understanding the formulas. So moving on, whether or not the enterprise has a goodwill or other intangible value. So we were discussing some organizations have specific or unique assets where the others do not have. So as a result, there has more potential value than the others. If I give you an example, certain organizations have a patent, let's say a specific patent, where it's a major asset for them. It's an intangible asset. It can be probably the license to do that particular trade in that particular area. It can be a certain contract with the government. It can be probably, if you take an example for a bookshop, the rights on the author rights or the copyrights can be a main asset for that particular organization, which is not tangible, but it's a huge impact to the business. And also the enterprise, some organization has goodwill, we call the good name, the brand name. Some organizations have a negative goodwill. People don't like that organization. So when these things, the variables change, it has a huge impact to the value of the business. Finally, the market price of the stocks. Now you see some market price here refers to the share prices. Now in Sri Lanka, there are about 200, closer to 300 companies listed in the Colombo Stock Exchange. So they have a readily share price. So this share price has a huge impact to the value of the business. We are learning something called market capitalization, and when you are calculating this market capitalization, the market price has a huge impact to the value of the business. And when the market is not performing, it will impact the value of the business as well. If I give you an example, now when SoftLogic company, when they put their IPO in Sri Lanka, they price at 29 rupees on that particular day. But on the same day, the price went down to 14 rupees. The price they desired as 29 dropped to 14 rupees on the same day. So we have a question: what happened to the value of the business? Is it dropped by half the price, or the value, the firm has deteriorated by 50% on the same day? So we have a question: what is happening? So will it reflect the right value of the business? On the same time, Singer Finance, when they introduced the IPO price was 15 rupees. On the same day, it went to 45 rupees, 3 times high. So does it mean that the value of the firm increased 3 times on the same day? Is it practical? Is it possible? So we have to question how accurate is this, how well it will reflect the value of the firm. So there are so many questions which coming up when it comes to pricing a business based on the market value. Right, okay, so these are some of the factors that we need to consider when it comes to valuing the business. Right, so this is a much more an approach that we use to value a business on a more research based on a research article. It's a very well famous model, so I thought to show you also to get an idea when it comes to valuing a business. So as you can see, this model shows to arrive the value of this particular firm, they have done mainly two analyses. One is the financial statement analysis and the business analysis. Okay, to arrive the value of the firm, they have done mainly the financial statement analysis and the business analysis. Now I'm sure in the past 8 presentations you would have learned how to analyze financial statements, and we need to know how this analysis helps to value the business, the next step forward. And also we'll spend a little bit of time on discussing the business analysis and how we can arrive a value of the business based on these two analysis. So let's start from the business analysis. So when it comes to business analysis, I want to emphasize some key things. So it says it is a process where the business analysis that aims to identify companies' value drivers and understand how they are affecting the company. Furthermore, the risk factors should be distinguished. The business analysis can be divided into 2 parts, internal and external analysis. So and so forth, 2003. So this article emphasizes that what is a business analysis means. So it is simply aims to identify companies' value drivers. What do you mean by companies' value drivers? Which creates the value to the business. It's trying to understand what are the main value drivers to the business and how they affecting the company. So that's all about understanding the main value drivers and how it affect to the company. So probably in strategic management, you'll spend corporate strategy, you may learn what are the value drivers to a business and how it creates the value to the business. So we'll start with the business analysis, the 2 main sections. First one is the internal analysis. So what do you mean by internal analysis? So internal analysis is all about the financial statement analysis that you have been doing in the past. So I'm not going to touch much on this area. This is all about calculation of ratios, and by looking at the ratios, you are trying to interpret the organization. So I'm sure you are mastering on that particular area. So I'm not going to touch on that. Now I'll be more focusing on the other areas because you have a better idea about the financial statement analysis. So that's about the internal factors. So let's move on to the external factors of the business analysis. So these are some of the external factors which affect the value of the business. The first one is the competition. You know what is competition? So when you have a lot of competition, it has a huge impact to the value of the business. When some industries has high competition, some industries has low competition. Probably you would have learned a model which is called the 5 forces model to get an idea about the competition, the level or the attractiveness in the particular industry. And some organizations have competitive advantage. So because of the competitive advantage, the value of the business may vary. Okay. The business know-how, the best technologies they have. If you take an example, Toyota, because of their hybrid model, because of the new technology they come up, they have a competitive edge over the other automakers in the world in terms of their new technology. And also the market segment and the domain. So some organizations are the market leader of that particular segment. As a result, they have a strong financial position than the others. It can be they have a monopoly in the particular market. So if you have a monopoly in that particular segment, it creates a lot of business value to you because it has a lot of financial strength. If you take an example, Chevron, you call this Caltex, Delo, have been the market leader for so many years. So therefore, even though they have competition, being the market leader, they have a strong cash flow projections for the future. And also industry trends. Now you see, especially country like Sri Lanka, we have booming industries such as construction, tourism. So when such industries are booming, the organizations in that particular industry creates more value than the others. Why? It has more potential. You're expecting more tourist arrivals, expecting more construction projects for the country. That creates more business value for such organizations. And also the pestle factors that you have already heard of before, the political, economic, social, technological, and environmental and legal factors has a huge impact for the business value of the firm. Right, so this is some of the factors that we need to consider when we are arriving the business value for the firm. Let's move on. Now, just to refresh what I've been doing so far, I said it is not easy to give a value to the business. And I said it's a highly subjective thing than an objective one. Therefore, we need to know so many factors before coming up with a value. So many factors to be considered. So, then we need to know why we need to do a business valuation. So as I told you, my presentation is all about answering for 3 questions. 1, what is business value? What do you really mean by business value? Second one, why we need to do a business valuation? What is it? It is important, or does it have a important characteristics for the business, or do we need to really do a business valuation? And finally, if it is yes, how we need to do it. So these are the 3 sections. So now we are in why we need to do a business valuation. As you can see, there are a list of a lot of items, list of things that we need to know why we need to value a business. And some of the things are very general. It's not that difficult. You have to know the business valuation. If we want to purchase a firm, first thing we need to know, okay, what is the value of that firm? But because for you to purchase something, we need to have a commercial value for that. So we need to do a business valuation to arrive that for the business purchase. Or sometimes you may decide that you want to sell your business, or partly or fully. Some groups, they want to get rid of certain sections of their group, so that they need to know the value of that particular firm before they sell their business. And the next one, mergers and acquisition. We will be spending more time on mergers and acquisitions in the future, but whether it's a merger means we are combining two entities to another firm, and acquisition, we are going to take over another firm fully. So if you are going to do both, still we need to know what is the value of that merger or what is the value of that acquisition before doing that particular act. And there's something called restructuring. Restructuring means basically doing a change in the business. It can be an operational change, it can be the capital structure change, it can be the management change, or we are going to move from one business to another business. So whatever restructuring, we need to know what is the value created by that change and what is the impact to the value of the business from that restructuring. So therefore, again, some organizations try to get a value before restructuring and after restructuring, how it has changed. And another one, LBO, you call leverage buyouts. Now, have you discussed this leverage buyouts before, or do I need to brief what it is? Have you discussed? Yeah, better to brief. Yeah. So leverage buyout means, now sometimes if you take an example, let's say one firm, let's say firm A want to take over the firm B, right? So when they are going to take over firm B, you need to put some money to take over this firm. So when you are going to put some money, most of the time they may not have enough cash to fund on their own to take over. So they take a help from a financial institution in form of a debt to capitalize this particular acquisition. So if you are going to take over a firm through high percentage of debt, normally they say around 90% of debt, then you call it's a leverage buyout. So if a firm is taking another firm with funding more by debt, it's a leverage buyout. So it's another way of buying. Okay, still we need to know the value. Okay, how much we are going to pay for this particular business. So therefore we need to do a business valuation. Next one, management buyout, MBO. Have you heard this management buyout? So it's another form of taking over the business. Now if you take an example, let's say owners have been continuing this business and now they feel like exit from that particular business. So the first option that probably they may ask from the current management, we want to quit from this particular business. Do you like to take over or take this business for yourself? Probably they may ask from the current senior management who are employing in this organization, would you like to take over this firm? We are happy to give it to you if you are interested. So if that's the case, the current management, the key people may decide, okay, fine, we are happy to take over your firm, fine. So the management is going to take over the ownership of the firm. It's another purchase of a business, but the existing management is going to buy the firm. So therefore they call management buyout. The current management is buying the organization. So that's what we call a management buyout. These are all different types of buyouts, but what kind of a purchase is that, still we need to know the value of the business. So for them to put forward, okay, fine, we will take this business, but for this particular value only. Okay, so therefore even for a management buyout, we need to value the business. Now we'll move to the most important, one of the key reasons for a business valuation is the IPO, initial public offer. Initial public offer. Now Have you heard this initial public offer? I'll explain briefly. Initial public offer means when a firm want to become a listed organization in whatever the listing indexes of a country, they want to give a value to the public. Okay, you can buy or part of this business by taking over our share at this price. So there should be a value that you need to put forward to the public to become a shareholder. So if you are doing initially the first time into the market, you need to come up with a price to the current public to take over or be a part of your organization. So you need to calculate your initial public offer price. So initially you calculate the price and put forward to the commission of that particular country. It can be the Colombo Stock Exchange, the commission of the Security Exchange Commission in Sri Lanka. You need to put forward, okay, this is the price we are going to quote. So then they will do some calculations and approve that price. If they are not approving, you need to recalculate and come up with a price that both parties are agree. And then once you confirm the price, you can put forward to the market, okay, this is the price gonna be. But then again, you're going to give a value to the business. So therefore, you need to do a proper business valuation if you are going to give a value to the business. Now, when it comes to IPO, there are so many Sri Lankan IPOs in the past. They were coming up with different IPO prices. As I told you, the Soflogic came up with the IPO price was 29 rupees. Expo Lanka, they came up with the IPO price was 14 rupees. Texas Jersey, they came up with the IPO price of 15 rupees. So like that, you come up with a price. The Union Bank, they come up with the IPO of 25 rupees. So how do they tell this price? One organizations, they say the price is 3 rupees, and other organizations say their price is 15 or 20. So we don't know how they come up with the value. We should know how to do that. So therefore, to arrive that price, we need to do a proper business valuation. If you can take an example, Laugh Gas. Now Laugh Gas, it was an entrepreneur who developed, he called Mr. Vegapitiya, started his own business few years ago, around 15 years ago. There was a recent seminar, how a very inspirational leader, he said that he started his business from 300 rupees. But when they want to go for the IPO price, they want to value the business, and it was 36 billion rupees. So from 300 rupees over the 15 years, that also he got as a gift from his friends when he was in the university at the time of his marriage. He put that money to start his business, and over these years he has developed it, and the group value when they are going for the IPO was 36 billion, and they were owning a couple of ships as well. So then they come up with the price, they got the value of the business, and they divide by the number of shares they have, and they say, okay, our value of the business is this. So if you want to be a part of it, you need to buy the price at this price. So they give a price and put it to the stock exchange, and once they get the approval, then it will be the IPO price. So initial public offer is a key area that we are addressing in our presentation. We are going to understand, or there will be questions based on the information. You need to suggest an IPO price to your firm. Okay, so if you are working in your own firms and if it is not listed, after learning this particular exercise, you should be able to tell, okay, if we are going for a listed company, this is the price we need to quote to the public. Okay, so that is the level of knowledge that we should gain after learning this particular area, how to value a business. Right, so the next one is ESOPs, which is called the Employee Share Option Scheme. Employee Share Option Scheme. Now, Employee Share Option Schemes are also available in Sri Lanka and most of the international organizations. Very simply, it's about if you want to retain your key employees. And if they have been very valuable to your firm, what the management do is over time, they will be a part of their shareholding as well. So if you've been paid a salary, okay, you are not that loyal to the firm. But if you are a part of the shareholding also, you are more attracted and motivated, and you don't feel like leaving the business. Now you are part of the business, you are owning the business. So you want to really improve more, and so that your value of the business further increase and your wealth also increase accordingly. If you look at all the key people, as I was telling in the billionaires index, how they have become billionaires, because they own a lot of firms. So when the share prices of those firms increases, automatically they will increase the index number over the period because of the share price movements. Why? The ownership also changes over time. So therefore, you need to keep in mind that it has a huge impact to the business. So again, if you are going to give a price to your current or existing employees, you need to give a value. Okay, this is the value of shares that we are going to give it to you. For that, you need to give a business valuation. You need to know the total value of the business to value that employee share option scheme as well. So therefore, for that particular activity also we need business valuation. And then we have buyback of shares. We call share buybacks. It was illegal in Sri Lanka for some time, but it is now accepted. Now it's legalized. So a firm can buy back their shares. Do you want me to explain further on that? Buyback means this particular activity. Yeah, it's very simply, if you take an example, let's say now Laugh Gas went to the market by introducing an IPO price. So all of us become shareholders. Let's say you're also interested, I also interested, so we bought shares. Now, when the company is performing, they may decide, okay, we can buy back some of our shares in the market from our own money. Now, if you take an example, now let's say 40% of the shares has been given to the public. Now the company has, let's say, more reserves. They are thinking, okay, can we take some shares to us back? So from that 40%, let's say another 5%, we are from the market, we sell to the market. And so let's say you are holding some shares, they will pay you some money and buy back the shares to the firm again. So that the retaining percentage, now it's increased from, if it is 60% from the firm, now it will increase to 65. The market, the public ownership has reduced from 40 to 35% because 5% was took over by the firm again, buyback. So therefore, not necessarily. Now, if you take an example, let's say current prevailing price is 13 rupees. Let's say the market is not performing. The stock market is not performing. So the price has gone down to 8 rupees now. You know that is not due to the company performance has gone down. You know the company is performing every year. So the management may think, okay, this is a good opportunity for us. We can buy the share at 8 rupees. Why? Our IPO price was 13 rupees. And we have got money for 13 rupees. But even the company has performed, but the price in the market has gone down. So this is a good opportunity to take some more shares so that we can retain the dividends. We don't need to pay to the dividends to the current shareholders. Why? We are taking back means that reserves can be developed within the business. So if you don't have much projects at the moment and the market is not performing, this is a good chance to buy more shares. So in that instance, they may decide to buy more shares. But if the price is very high, then probably they may sell at that point. They will buy for 8 rupees. Over time, now the market has performed due to all these pestle factors. Now the market is booming. Now it is the time you can sell the shares and get a profit also. That will be a capital gain for your business. So you are doing some trading within your own shares. So therefore, firms do that. When the performance of the market is not good, they will buy back shares for that. So, so that's one of the reasons they do the buyback, and for several reasons as well. Now, if you want to improve your ownership, if you want to be more strong, you, let's say at the moment you have put it to the market of 49% and your strength is around 51%. So you're a little bit scared. Somebody can take over you. There can be a hostile takeover. Somebody in your own family can sell the shares and somebody can take over your firm. So you are a little bit concerned about it. So what you do is you buy some shares from the market. So your retention is now high. So even within your team, somebody sell the shares, still you have that strength of ownership so that you can continue with your business. So for so many reasons, buybacks are happening. Keep in mind the buyback. So if you want to do a buyback, then again, you need to value the business. So therefore, business valuation is important. Project financing. So project financing is another reason. If you are going to go ahead with, let's say, probably taking over the firm can be your main project. Okay, taking over the acquiring another firm can be your main objective. So then you need to know how much you need to finance it, so that you need to know the value of the business. If you take an example, sometimes let's say you have a project which you need 100 million rupees. So you're asking for a loan from the financial institution, and financial institution says, look here, okay, we can give you 100 million, but we need to know what is your strength. So they may do a business valuation of your business before giving that loan, because they need to have the confidence, okay, whether we are secure to finance that particular loan. So if you are going to finance a particular project, or it can be a building, or it can be a particular construction, again, you need to do a business valuation for the funding purposes. Okay. Another point, bankruptcy. I'm sure you know what is bankruptcy means. Now, bankruptcy is the last thing that we want to think. Okay, we are doing a business valuation, but you need to understand, even at a bankruptcy situation, one of the main activities that the court may ask you to do is to value the business. Okay, fine, the company is going to close down. What is the current value of the firm? How much you can retain, how much you can recover. So you need to know what is the current value. So therefore, you need to do a business valuation on that. Now, so when it comes to bankruptcy, business valuation is essential. Okay, it's a must. It's true kind of a financial requirement. So then the next one, valuation for court cases. Sometimes you might have to value your business due to a legal requirement, such as a court case. It can be a contractual disputes, it can be a ownership disputes cases, it can be a divorce case, it can be a intellectual property cases, or any dispute. If there is processing through a case, the court may say, okay, we need to know the current value of the firm, or how much that particular person is, what is the value or the wealth that particular firm has. Because let's say it is run by the husband and wife, and then if there is a divorce, they may want to split the firm. So they need to know the value of the firm before splitting that. So you need to do a business valuation to understand what is the value of that particular firm. Then valuation for compliance. So as a legal requirement, you may have to do valuations for many reasons, like for IPOs or for special business reasons or any disputes, for so many reasons. As a compliance, we need to do a valuation. Another one, fair value accounting and tax issues. So again, for tax reasons, probably the government want to revalue the business and see what is the current status. And finally, valuation for strategic planning. I mean, these are some of the reasons why we need to value. So just to get an idea why it is important, we need to value. We still did not value the business. We are just learning why we need to value. Okay, so these are some of the points. Okay, but they are the key points why we need to value a business. Okay. So the next move is to understand how. Right? So we discuss what is business valuation is all about. We discuss why we need to value the business, and now we need to know the most important thing. Okay, the most important thing, and we spend most of the time on this particular area. How are we going to value a business? So they say it's subjective, they say it's an art, but somehow we need to come up with a value and we should be able to justify. So therefore, we are going to know how to value a business. Right, so let's move on. How can we value a business? So you need to keep in mind there are so many approaches to value a business, and fundamentally there are three approaches that we have to discuss on how we can value the business. One is from an asset approach, from an income approach, and from a market approach. So also you need to keep in mind all these approaches may vary, whether it's asset or an income or a market approach may vary based on the information which is available, and also what are the influencing factors on that. So when the factors are changing, sometimes the suitability of that particular approach may not be there. In other words, so if you don't have some of the data, you won't be able to use some of these approaches. So therefore, based on availability of data, we may go for these approaches. Right. So let's start with the asset approach. Now this is a very common approach where you and I can understand, even a kid can understand. I want to know what is the value of me, or what is the wealth of me. So I need to know my assets, what I have. So that is the easiest and most understandable method of giving a value to a firm or a person, understanding what I have, what I own. Now, sometimes, mainly I may concern, okay, I may have a land, I may have a vehicle, I may have a house, what I own for my name. So that's all my assets. But sometimes when we look at things, if you take an example, we see people are coming up with very expensive cars, they have big houses like palaces, and people think they are very rich. They're rich. But you need to understand that's not the real value. For us to get the real value from the total assets they have, you need to deduct the liabilities they have. Probably that a big house is funded by a big housing loan. or that expensive vehicle is through a expensive lease. So just because we have assets, we can't say that particular person is wealthy. This is a very important thing. So, but we tend to see, by we look at only the asset part and we think, okay, this person is rich, this person, the wealth is high. But we need to know what about the liabilities? What about his obligations? So if you want to know the real wealth or the value from the total assets he belongs, you need to deduct the liabilities that you own so that you can get a real value of the business. You call that net asset value of the person or the business. Now, when I'm talking about this, a very famous personality in the world who is assumed to be one of the richest people in the world, is no longer called is the richest person. This person is a very popular singer. I'm sure you have heard of this person. You call the rock king, the Michael Jackson. Okay. Now, it is said that he is a bankrupt person. The bankrupt person. Why? Because he has so many assets, but when it comes to liabilities, also more than the assets. So if your liabilities are more than the assets, even though you have a lot of assets, you are negative net asset value. In very simply, you are a bankrupt person. Okay, so it's very important when it comes to businesses. Some organizations, you think, okay, they have a lot of lands, they have a lot of buildings, they have a lot of factories, but the company is bankrupt. Why? They have more loans than what they own. So very simply, if you have more liabilities than what you have, it's a bankrupt organization. So that's very important thing that you need to understand. Don't carry the weight from the assets of a business or a person. You need to know their exact liabilities as well to get a real understanding what is the real business value. So therefore, it estimates the value of a business by valuing the tangible and intangible assets of the enterprise. Not only tangible, but also intangible. Sometimes the intangible value is higher than the tangible value as well. So we were discussing about patent rights, the particular license, or the copyrights, or the loyalty contracts that you have, royalty contracts that you have, maybe a intangible asset over the tangible assets. So therefore, we need to identify what is the tangible and intangible assets of the enterprise, plus you need to deduct the liabilities as well. So the model we are using the adjusted net asset method. So adjusted net asset method. So let's get an idea what do you really mean by adjusted net asset method. So as I told you, the valuation approach, you have asset approach, which we are discussing about the tangible and intangible value of the business, which is covered in adjusted net asset method. See, the other one, what we were discussing about the income approach. Now, income approach means we are giving a future value also to the business now. Now, it's very important. Now, if you are trying to get an idea of a particular person or a business, we look at the asset value or what he or she owns. But we never look at the potential value that he or she has. The talent and the capabilities that particular person has. What kind of a person that he or she will be in another 10 years' time. It's very difficult to calculate, but it's very important. If you are going to give a value to a business or a person, we need to know the potential value of that firm. So even though we are not addressing the potential value in the net asset method, income approach is all about estimating the value of the business based on the future earning streams. We are looking at the future capability or the future cash flows of the business and telling a value today. Fine. This value of the business, let's say 100 million or 200 million based on the future earnings. Based on the future earnings. So what kind of a person or the business is going to be in another few years' time. So we predict so many things here. Okay. So there are two approaches we are addressing on discounting and capitalization, which will be discussing in detail in the future, which I'm explaining one by one in detail. Right? So that's about the income approach. So I was talking about asset approach, where we are trying to give the value of the business based on assets. Income approach, we are trying to give the value based on the future earning stream. So we are going to give a potential value there. The next one is about the market approach. So I was talking about three approaches. So this is the last approach. The market approach is basically we are trying to give a value based on the market information. Based on the market information. So what do you mean by a market information? From the demand and supply, you may given a price. From the demand and supply, you may given a price. So from that, you can get an idea what's gonna be your value of the particular business activity or the section. So estimate the value of a firm by direct comparison to comparable listed company and similar investment that have been sold. So you are trying to get either a proxy firm or the market price. If you have some, you know that there are about lot of companies are registered in Sri Lanka, but only few in the Colombo Stock Exchange. So not every firm has a readily available price. So majority of the firms do not have a readily available price, a market price. So then you are trying to get a proxy company. You call proxy means you are going to take another person, another organization, and by understanding their price, we are coming up a price to us. If you take an example, let's say, hypothetically, we'll say we have Dialog and Mobitel. They are very strong competitors. So let's say Dialog has a market price in the Colombo Stock Exchange. Based on that market price, we are trying to come up with a price to Mobitel. Okay, so we are trying to take another firm price to identify our particular firm's value. So we call the market approach, but we are discussing in detail. Okay, so just to refresh, when it comes to how to value a business, there are three approaches: asset approach, income approach, and the market approach. And asset is simply calculating the tangible and intangible value of the business. Income approach, where we are trying to get the future income stream of the business or the potential value of the business. Market approach means we take a proxy company or market forces to arrive the value of the firm. Yeah, kind of a benchmark. We can now, if you take an example, every firm in that particular domain or the segment, we can find another equivalent partner. So if you can find an equivalent partner who have a readily available price, by understanding that particular price, we are trying to come up with a price to our firm. Okay. Any questions so far? Anything to do with valuation approaches? Anything that you want me to further clarify? I'll take a 5 minutes break and then we continue. Right. So in the previous session before the break, we were discussing about the main valuation approaches, which is the asset approach, the income approach, and the market approach. So we are going to go in detail of this particular section. So we'll start with adjusted net asset method. Adjusted net asset method. So when it comes to adjusted net asset method, as I told you, it's simply to calculate the net asset value of the business. To calculate the net asset value of the business. So as it explained, valuation analyst relates all the assets and liabilities of the subject company from their historical cost basis to fair market value. The fair market value of the asset minus the fair market value of the liabilities equals the fair value of the owner's equity. If you take an example, it's simply you know the accounting equation. So if you take an example, we know total assets of the business is equal to liabilities plus capital. So if you want to know the net asset value, simply total assets minus liabilities is the capital value. So the capital value is the owner's equity value is the net asset value of the business. So if you want to know the fair value of this equity, we need to know the fair value of assets minus the fair value of liability as well. So then we can calculate the net asset value method, which is much more easy to calculate and understand. So if you look at this particular chart, it is kind of a balance sheet format. Okay, I'm sure you are very aware of this structure, where, as you can see, the total assets represent the current assets and the non-current assets. From that, if you deduct the liabilities, which is the short-term and the long-term liabilities, then you will get the net asset value of the business, which is the equity and the reserves of the business, or you call the shareholders' funds. So from a balance sheet point of view, by using a balance sheet figure, you should be able to calculate the net asset value method. So this is much more a detailed one for your understanding. As you can see, in this particular organization, the values are in million, and the currency is pound, British pound, and you can see the fixed assets are mentioned, and then you add the current assets, and then you have liabilities. You call the creditors amount falling due within 1 year, you call the current liabilities, and for creditors amounts falling due after more than 1 year, which is we call the non-current liabilities, and the provisions for liabilities and charges, you have 152 million. So when you look at the net assets, from the total assets, if you deduct the liabilities, you find 3,147, which is the net asset value of the particular business. So as you can see, this is equal to company shareholders funds, and when they have minority, the minority interest plus the shareholders funds are equal to the total or the net asset value of the business. So this is how we to calculate or arrive the net asset value of the firm. Okay, let's move on. Now this is some calculation or the information for you to get an idea the net asset value compare with another valuation model, and net asset value model will give you certain values of the organization. Starting, if you look at the last one, the Vodafone, it has a huge value of 131 million, where Bloomberry has 59 million. So a firm with a large capital base or asset base firm to a very small asset base firm, you can get an idea by the net asset value. But also in this way you find the total capitalization, or in other words the market capitalization. This is actually the market price of the business or the market value of the business. So if you look at the example of Bloomberry, the net asset value of this, it's a UK firm, UK based firm in the London Stock Exchange. The net asset value is 59 million, where the market value is 183 million. So you can see the difference of those two firms, of those two values based on the valuation method. And sometimes the net asset value is higher than the market capitalization also. If you look at the last situation, the net asset value is 131 million, but market capitalization is 93,000 million. So you can see some organizations, their net asset value is higher than the market capitalization as well. But we will further discuss about that. So this is how we are going to calculate the net asset value. Now we need to get an idea the advantages of this method. So as I told you, it's easy to understand and easy to calculate. That's the most important factor, where compared to all the other models, this is the easiest model to calculate. Why we say it's the easiest model? Because all of you, we have been doing an assignment where you got the information from financial statements, annual reports. So these annual reports are published and it's freely available. So if you can get the freely available data, any one of you can go to their website or their particular financial statement and calculate the value of the business. So the informations are easily accessible, and so therefore easy to calculate your value of the net assets. Also, especially relevant in tangible assets, intensive business is valuing controlling ownership. As I told you, when a firm is representing with lot of tangible assets, this model representing a fair value, a better value than a firm with less tangible assets. The other important thing is it shows the minimum value of the firm. What do you mean by minimum value of the firm? Minimum value of the firm. Minimum value means, now if I give you an example, if A is going to take over B, you need to give a price where the B should attract to sell that particular firm to A. So one of the first things that A will say, let's say B own, the firm has, the company B has let's say 80 million net book value. The firm has an 80 million net book value. What do you mean by the 80 million net book value? We told as it's a fair value. If you want to close your business today, you can sell your assets at a particular price and you can settle all your liabilities and you can have 80 million cash to your hand. You can sell all your assets, you can settle all your liabilities, short-term and long-term liabilities, and still you have 80 million assets. So if A is going to take over B, now we know that anyway they have 80 million in their hand. If they want to sell the business in the open market, they sell their assets, settle their liabilities, and get 80 million to their hand. Therefore, for A to take over B, at least there should be an attraction or a motivation value that they have to give for B. It has to be more than that 80 million. Because in the open market, if you can sell your business at 80 million, you're not interested to sell to A at 80 million. So it is the minimum value that you need to approach this firm. So if I want to take over B and if I suggest, okay, we would like to take you at 60 million, we will not be interested. At least if you are going to have a motivational bid, you need to start from 80 million. So that's why they say it is the minimum value for a bidder to request this firm. Otherwise, there's no motivation for B to sell their business to A. Why? You may think, okay, why we are giving to 60 million for A, where in the open market I can get 80 million. But therefore, keep in mind, this method is a very important method in the time of acquisition, because it represents the minimum value for the firm, the minimum bid price that you need to quote if you are going to take over such firm in a process of acquisition. So obviously, we will not be happy to sell that firm at 80 million, so A has to increase the bid, probably 90 million, 100 million, 120 million, 150 million. So, but that entire process, you can start with a price, and that is the minimum value of the firm, that is 80 million, right? Any questions on that? Any questions? Okay, so we were discussing, it gives the minimum value to the business, right? So what are so having said that the minimum value, another important point that I need to explain. Now, if the business, as I told you, it's 80 million, that shows the firm do not have a future value. Why? If you can sell your current prevailing assets and settle your liabilities and get 80 million to your hand, that means today's value. In other words, it shows that you don't have a future value in this organization. Okay, so now obviously the B will not be happy to sell this particular firm to A at that minimum value. Why? Because they have been doing this business over a period of time and they have created a brand image and they have a good customer base over the years. So they are trying to increase the value. So because they have a future value also. So therefore, the net asset value will not represent the future value of the business. It just shows, assuming there is no future value, what is the current value of the business, assuming there's no future value. So therefore, it's another weakness as well. Even though it is a price that we can start with, it has a weakness, but because it does not show the future value of the business. So let's focus on the main disadvantages. First one, expensive and difficult to get reliable market derived data for valuation for many assets and liabilities. Now we are trying to give a market value for the business. We are trying to give an asset and every liability a market value. So do you think it's that easy? It is said now, let's say if you take an example, let's say you have a car. You want to sell this car, but still you have not sold it. So you're thinking you can sell this car for, let's say, 2 million. You assume that you can sell this car for 2 million by looking at the newspaper, by looking at the prevailing prices and the probably vehicle market websites. You think, okay, I can sell it for 2 million. That's a assumed value. But when I'm actually selling the particular vehicle, I may not sell for 2 million. Most of the time, lesser than what I expect. Because probably the buyer may bargain with you, and if you want to sell it sooner, you may just settle it lesser than 2 million. So you can see the the assumed value or the fair value is different to what the actual transaction happened. So even we assume that we can sell this business for this amount, we can sell this particular asset for this amount, and we can settle this liability for this particular amount. In the reality, it may not be the case. There can be penalties, there can be extra payments that you need to pay, and there can be more commissions and so many other things. As a result, they say it's not easy to get a reliable value in the market for many assets and liabilities. Even if you take a land, you look at the next or neighboring land and think, okay, I also can sell my land for this, but it may not be the case. So therefore, that's why they say by assuming you can't take unless you sell your asset, then you can say, okay, I sold for this price. Unless that, you have a gap. That may be not the right value you are going to represent. And the valuation of intangible and contingent items may be considered speculative, which is not realistic. Now, if you take an example, when some of the intangible assets, things like human capital and intellectual capital, it's not realistic and it's not easy to give a value. So we know it's important, but we can't give a value. So therefore, it will not reflect the right value of the business. So that's one of the weaknesses of this method. And another important thing, subject for accounting manipulations. Now, what do you mean by accounting manipulations? Being in accounting and learning accounting, you would have saw that we have accrual concepts and so many accounting standards we are following. And sometimes if you want to, if based on your intention, sometimes you can create some negative behaviors by applying certain accounting rules and regulations, and you can manipulate the entire system. So therefore, because net asset value is calculated the fair value of the assets, it doesn't consider the cash flows of the business. So therefore, sometimes you may show a very high profit on the organization, but in reality you don't have much cash profit for that. So therefore, due to depreciation and so many like stock valuation methods and for so many things, you can manipulate the numbers. As a result, the net asset method will not reflect the realistic values. Okay, so these are some of the pros and cons of net asset value method. And also, as I told you, it does not reflect the future value of the business. Therefore, we can't rely on this value 100%. We need to know the disadvantages also. Yes, it's easy to calculate, it's easy to understand, it's a minimum value for a bit, but then again, it's subject to so many weaknesses as well. Are we okay with that? Any particular areas that you want to clarify on them? Okay, shall we move on? Right. Okay, so that's about the net asset approach. So let's move on to the income approach. So as I told you, we have three approaches. What we discuss is the net asset approach so far. Now we are moving to income approach. So what do you mean by income approach? It's simply it is a technique which provides an estimation of the value of the asset based on the present value of the expected cash flows. It is based on the present value of the expected cash flows. Now, I'm sure you have learned the concept of present value. Okay, so you have a better idea what you really mean by a present value of expected cash flows. Now, keep in mind, these are future cash flows. Now, I told you in the net asset method, one of the main weaknesses is it does not give a future value to the business. It's just say what are the current assets you have, what are the current the liabilities you have, and you are trying to give a value to the business. But in this particular approach, it addresses that weakness by considering the future cash flows of the business. So in this method, what we are trying to do is we are concerned about the future cash flows of the business and converting all the future cash flows into today's term and try to give a value to the business. Totally opposite of the net asset approach, where we are looking the future expected cash flows. And as I told you, cash flows are very important to get a better idea about the value of the business. So we are emphasis on cash flows in this particular method. So this model has mainly two forms, okay, and one is the dividend valuation model, or you call the dividend growth model. They call this Gordon's dividend growth model because the person who called Gordon, he's actually came up with this concept. So therefore they call Gordon's dividend growth model, or you call dividend valuation model. So it's you call DVM or DGM, dividend growth model or dividend valuation model. Okay, so and the other method that we are discussing is the discounted cash flow analysis. So I'm sure you have a better idea about discounted cash flows. So we are using a discounted cash flow approach to arrive the value of the business as well. Okay. So from there we will move on to the dividend growth model. The dividend growth model. Right. So dividend growth model means it is a model we use only cash flows that the investor cash flows of the business and try to arrive a value for the business. So why we take cash flows? It is said that when you look at from an investor point of view, the only cash flow an investor receive is the dividends. From an investor point of view, from the business, they receive dividends. That's their only cash flow. So what they are trying to do is this Gordon is coming up with, he's trying to estimate the total amount of dividends the investor is going to get for the future. Let's say the business from today onwards, every year the investors are getting dividends. So he's trying to calculate all the dividends that the firm is going to get in the future and get the present value of all those dividends and tell, look here, this is the value of the business. So how do you come up with this particular value? He take all the future or the expected dividends the company is going to pay in the future. Based on that only he calculate the value for the firm. Okay, so it's also said therefore the purpose is to better understand and interpret the earning power of the subject company. So if the firm has a higher earning power, okay, then we assume that they may pay higher dividends, therefore the value of the firm will be higher. Okay, so as I told you, we forecast the amount of dividends the firm is going to pay in the future and trying to come up with a value today based on the future dividends of the firm. But the last point is very important. Some firms have constant dividends. Some firms have constant dividend growth, and some firms have non-constant growth. As a model, this is used by many organizations, but it's subject to a lot of assumptions because some organizations have a constant dividend. What do you mean by a constant dividend? Constant dividend. Every year, the firm is paying a fixed dividend throughout the period. So in other words, let's say a firm has decided, okay, we will pay 10 rupees of a dividend every year. So as a policy now, if you look at Jana Shakti, they have a policy, pay 1 rupee dividend every year. So their share price is around 12 rupees, 13 rupees. So, but they will maintain a 1 rupee dividend every year for their shareholder. So for a 12 rupees of an investment, they will get a 1 rupee of a dividend every year. So it's just like a norm they maintain, but you can change with the time and you can change with the business performance. But some organizations, they maintain kind of a constant dividend as a policy. Opposed to that, there are some organizations have a constant dividend growth. What is that? Not the fixed dividend. Okay, you will have a dividend with a constant dividend growth. So if you take an example, let's say we are giving 10 rupees this year, we are having a 10% a growth rate also on top of it. So next year we are not going to give 10 rupees, but if you have a 10% growth rate, you are going to pay 11% in the following year. Like that, you will have a constant dividend growth. So the growth rate is 10%. So every year we are trying to give a 10% growth for the future. The last one is non-constant growth. Non-constant growth is like, this is a more practical situation. Any firm can't say from today till infinity, we will pay the fixed dividend. Because you know the business world is changing on a yearly basis. Also, any firm can't say we will grow our dividend on this constant rate forever. So non-constant growth is more realistic, where next 3 years we will have a 10% growth. Following year it will be a 3%. Probably another 2 years there's no growth at all. So a situation of so much of fluctuations. So it's a situation of non-constant growth. So these are the 3 types of organizations that may prevail in an organization. So we need to understand how we are going to address of each and every situation. If the firm has a constant dividend, how to give a value to the firm. If the firm has a constant dividend growth, how we are going to give the value for the firm. If the firm do not have a constant growth, still how are we going to give a value to the firm? Because these are different scenarios. So when you are giving the value, you should address these different scenarios as well. Right? So now we are trying to understand how we are going to give a value to the business. Okay. Now, this is an example for a constant dividend firm. A firm, it is giving a constant dividend. So let's see. If a firm is expected to pay dividends of 20 pence per year, 20 pence means, so every year you are getting 20 pence as dividends for your shares, and you've been paid till infinity forever, and the rate of return required on a share of this risk class is 12% per annum. Okay, so you would have learned the risk class and the rate of return in financial management. So there you are trying to calculate the you call cost of capital for this, the rate of return, or the discount factor. They say it is 12%. So if you look at in the first year, you are going to get 20 pence. Okay, and if you look at the timeline, in year 1, you are going to get 20 pence. But if you look at in today's term, you are going to discount it. So how do you discount? You take 1 plus R. 1 plus R is the R is the rate of return. So 1 plus R is 1.12. So you can see in today's term that 20 pence is 17.86 pence. So you are assuming following year also, year 2 also, we are going to get another dividend, year 2. So then again year 2 we are going to get 20p, but when you convert into today's term, actually the real value is 15.94. 15.94. So third year also you are going to get, so that also you convert into today's term, so you'll get a figure like that. But we need to do forever. If you do forever, only you will be able to get the value of the business. You can see P0 means price of the business today. 0 means always today. You know, in investment appraisal, 0 means always today. So if you want to know the today's value based on future expected cash flows, okay, you can take for all these figures till infinity and total it and say this is the value of the business. But it's not practical. You can't calculate forever. So to avoid that situation, you can straight away apply this mathematical model where you have a fixed cash flow as the numerator, and KE you call the cost of equity as the denominator, and to arrive the value of the firm if the cash flows are on a perpetuity. Perpetuity means we are receiving continuously forever. So what you need to do is we need to know the dividends value, because see we are getting 20 pence per year forever. There's no growth here, it's constant forever. So it doesn't matter whether you are receiving D1 or D2, D3, D4, every year it's the same amount. KE is, keep in mind, it's not 1 plus R, it's just KE. KE means 0.12. Okay, so if you divide by KE, you can get the value of the firm. So what do you mean by 166.67 pence means if we are receiving 20 pence from this year forever, and if you take the present value every year and count or amalgamate it, the value of the firm is going to be 166.67 pence if you get the present value of that. Do you understand that part, or do you want me to explain it again? Fine. Okay, fine. So basically you try to give the value assuming there is no constant, assuming there's no growth in this particular business, same every year. So keep in mind, any firm, if you know a particular firm that you are getting 20 million every year, take 20 million as your numerator, take the denominator, the cost of equity of the firm, you may be able to get the value of the firm, assuming there is no growth. Assuming there's no growth, right? But it's again, you know, it's not practical because the firms either grow, you know, it has to be changed over the years, so it's not a highly practicable method. So So what we discussed, as I told you, we were talking about the constant dividend, and this is what we just discussed. If the firm has a constant dividend, how it's going to be valued in the future. Right. Now let's move to the next one. So this is about constant dividend. So let's see if the firm has a growth. It is a more realistic approach. If the firm has a growth, how are we going to account for the value of the business? Okay, here the firm has a growth. So you can see if the last dividend paid was D0 and the next is due in 1 year's D1, then this will be amounting to D0 1 plus G. Now this is very important. Now if you take an example, they say the D0 1 plus G, 1 plus G is equal to D1. D1 means dividends in 1 year's time. Dividends in 1 year's time. D0 means dividends you paid. Growth means the firm is expected to grow at certain percentage from this year to the next year. So if we want to know the dividends in 1 year's time, that is today's dividend plus the dividend growth. So that's why D1 is equal to D0 1 plus G. Okay, so that is very important that you should know. So if I draw a timeline, this is D0, this is D1. So how do I get the D1? Because D0 plus the G. Are we okay with the D1? Right, so this is D1. So this Grainer says if a firm is going to get a fixed or a constant dividend growth, you can value the firm by using this model. This is the model that you should know in terms of a situation where you are going to value the firm if the firm has a constant dividend growth. I can see the numerator is D1. So D1 means, as I told you, D1 means D0 into 1 plus G. And the numerator, the numerator is D1 and the denominator is KE minus G. KE minus G means, KE means, keep in mind it's cost of equity. KE means cost of equity. G means again the growth rate. So D1 means dividends in 1 year's time. KE means cost of equity. G means the growth rate of the firm. Okay, right. So let's calculate the value of the firm by using the equation. So now in this particular question, we'll look at the Shah PLC has just paid a dividend of 10 pence. and the firm's growth rate is 7% and risk adjusted discount rate is 11%. So these are three informations you have. One is their dividend is, I'll be just going through these calculations, like this presentation, and in the following class what I'm doing is I'm doing questions with you all. Now this is, I have given the answers and going through it, but in the next session I'll be giving questions and I'll be calculating with you all to arrive these numbers. So probably in this week you can go through this presentation, get an idea. So then the next one we will be doing calculation. So now I'm not going to do calculation, I'm just taking you through the presentation. So if you look at, if you know today dividends, the D0 is 10p and the growth rate is 7%, can we calculate the D1 now? By using this particular formula, we can calculate the D1. So what is the D1? 10 is D0, G means 7%, so 7% when it comes to when you are putting to 1 plus R, it goes as 0.07, and therefore the D1 is going to be 10.7. Are we clear with that? D1 is going to be 10.7. So we put 10.7 at the end. We put 10.7. Then what is the cost of equity? Cost of equity is 11%. So we put the 11% for here. And what is the growth rate? 7%. So we show the growth rate here. So if you apply this equation, you will get P0 as 267.50 pence. In other words, 26 pounds, 26.7 pounds. So they say if the firm is giving a dividend of 10 pence today and it's going to be grow as 7% forever, and the cost of equity is 11%, the value of a one share is 267.5 pence. That's what it's trying to say. So we were discussing first one, if the firm has no dividend growth, how are we arriving the figure? If the firm has a growth, constant growth, how are we arriving the figure? If you look at this equation, it is the extension what we have been discussing before. See, this is what we were discussing before. See, this is D1 divided by KE. That says no growth. So if you have a growth, you just add the growth here. So then you can calculate the constant dividend growth by that model as well. Right. Any questions so far? So here they have shown how they arrive it. So you don't need to worry about calculating one by one. I have just shown you, if you are interested, how they arrive these numbers. So if you can calculate all these things, but it's not practical because this is forever. So we are applying the easy mathematical tool to arrive the figure. Right? Now we will move to a situation where the firm has only dividends per share, where you need to calculate the growth rate. Sometimes you may not be given the growth rate, where you need to identify the growth rate based on the prevailing information. Now all of you can get this information from the financial statements. You would have tried before. When you are analyzing the financial statements in their sheets, they used to show their past history. What about their dividends per share? So let's say the dividends per share is there. Now we are trying to do is, now one of your assignment requirements is you are analyzing an organizational financial statements and giving a value in different forms that you learn. So net asset method, as I told you, you know, by looking at the balance sheet, you know your total assets, deduct the liabilities and get the net asset value. Okay. So your assignment, you need to select a company, and the same financial statement that you've been using, you can probably use for this as well. You are trying to give the valuation methods and arriving the value of the business based on what you're learning. Okay, so first one what we discussed was net asset value. This is about the income approach, the dividend growth model. So you may get this information in the financial statement. And how are we going to arrive the growth rate? You need to apply this formula to arrive the growth rate. So how are we applying that? If you can see, in this Pearson PLC in 1996, they used to give 16 pence of dividends, and they have been given 4 years information, and by 2003 they used to give a net dividend per share of 24.2. So if I just do a mathematical calculation, you can use your calculator and tell me, from 1996 to 2003, the firm's dividend share price has increased from 16.1 to 24.2. What is the dividend growth rate of this particular firm? Without applying this calculation, we use the calculation later. General feeling. From 16, it has gone to 24. Very simply, it has gone like from 8 pence of increase. And for how many years? From 1996 to 2003. Over 7 years, it has increased by 8 rupees. So what you can do is, now from 16 to 24, you have 8 pence or 8 pence difference. So it has increased by 50%, right? Because if I just show you the calculation, you have 24 and you have 16. You have 24 and minus 16, you have an increase of 8. So that 8, if you take from 16, basically it's a 50% increase, and that 50% increase is over how many years? 7 years. So if you take 50% divide by 7, what would be the answer you will get? Closer to 6%. Yeah, 6% increase per annum. Makes sense? It's like a 6% increase per annum, or 7%, close to 6 to 7%. So, but it's not that accurate. We just take a general feeling and say, okay, per annum it's a 6 or 7%. But to get a better calculation, they say we can apply the geometric value, so that you get the highest value. Here D means the maximum value or the highest value of this dividend. So what is the highest dividends per share? 24.2. As you can see, it is shown in the calculation 24.2. What is the lowest or the minimum value? Dividend, minimum dividend is 16.1. So here it shows 16.1. And here you get the 7 as the root, and particular answer you deduct 1. It's a mathematical formula, so you can get the exact growth rate over the years, and it's going to be 6%. So if I show you why we are getting 7, if you look from 1996 to 2003, how many total years you have? How many totals? If you look at count 1996 as 1, 1996, 1997, 1998, 1999, 2000, 2001, 2002, 2003. Basically 8 years are there. But the growth rate you compare from one year to another year. So here the n would be the number of steps. If you want a growth rate, you call the number of steps. Or from that 8 you deduct 1. Here it shows the number of years minus 1. Okay, you have to be careful. You don't put 8 here. From 1996 to 2003 there are 8 years, but for the growth rate we take the number of years. The steps you call, the number of steps would be 7, because from 1996 to 1997 it's only 1. That's why. Okay, it's not 2, it's actually 1. So therefore the number of steps going to be 8 minus 1, so it's going to be 7. So you need to be aware of that as well. Careful, because if you put 8, then your answer will be wrong. So from the amount that you get, if you deduct 1, you will get 6%. And you need to keep in mind these answers, you need to work out from your calculator and see whether you get these answers. The reason is sometimes even you have seen this, when you are really trying to apply for your calculator, you may struggle and you don't know how to do that. So sometimes the scientific calculators, they may vary from person to calculator to calculator. So you need to find the right shift and the mode to arrive this answer. So if you can do it, then you will get a growth rate of 6%. So now we'll go back to our calculation. What we are going to do is, a firm which they have given only dividends per share, K is given, growth we calculated, we are going to arrive the value of the firm. So we need to know the D1. What do you mean by D1? D1 we can arrive D0, 1 plus G. So let's find the D0. D0 means what? Dividends per share today. So what is the latest dividends per share? 24.2. That's D0. Okay. So you put D0 here. D0 here. 1 plus G. This is 1 plus G. 6% we arrived from the previous calculation. And down we get KE. So the denominator is 10%, which has been given in the previous question. It's given 10%. And the growth rate is 6%. So now see what's the new value of the firm. It's going to be 641 pence. But if you look at, it is said, if it is assumed that the historical growth rate will continue into the future, and I have showed a big if. Why is that? How can you tell today that this business will grow at 10% forever? I mean, any business, you can't say it will be increased at this percentage forever. If somebody is saying, then it's highly unreliable, because you know the businesses are changing. Even the most strongest businesses tend to collapse at the recession. So therefore, you cannot say that always the firm will be continuing. So that's one of the main weaknesses of this model. Will be coming back. So keep in mind, even though you arrive a value, it has its own weaknesses. Right. So what we've been doing is, just for a while, I will just refresh what I used to do. We used to learn the income approach. Under that, I told you we are trying to understand the value of the business by calculating its future dividends. But when it comes to calculating the future dividends, firms are different from one to another. Some firms give constant dividends, some they grow at a constant rate, and some do not go at that rate. So we just apply the simple formula to arrive the business by using the model where the dividend is constant. But if you have a growth, what you simply do is we will make sure the growth also incorporated. So we'll have a better formula like this. Okay. So you should know how to apply a question in your organization that you are selecting. You need to arrive the growth rate based on the dividends per share. You need to calculate the cost of equity. Probably you would have already done in your previous assignment. You need to calculate the cost of equity, or else I'll be explaining in the future to arrive the cost of equity in the next session. So it's a continuous learning thing. So in this week, what you can do is you can refresh the information that you already done for the first assignment, select that particular company and try to find this data. Of course, at the end of this session, you may be able to calculate the net asset value method and part of the dividend growth model as well. So yet to come. So there are PE models, cash flow method. So we are learning these models and applying to a real world scenario. And you are telling me this is the firm, let's say SoftLogic. Okay, this is the net asset value of this firm. This is the based on the dividend valuation model. This is the value. Based on the cash flow basis, this is the value. Based on PE method, this is the value, and telling me some alternative prices to acquire this firm. Okay. Right. And by that, we will be able to arrive the value of the firm. So if you know this is the share price that we are arriving, if you multiply by the number of shares, that's the value of the business. Okay. So that is the expected value for a one firm. Any question so far? So there will be calculations also, but today what I'm trying to do is going through an example in the presentation, and once we learn all the theories, then we'll be doing some calculations so that then you can apply and be more familiar with these formulas. So that's how I'm going to do that. And if you think there's any more suggestions, or if I've been too fast, or if